Before we get into this video, I need you to forget everything that you've been told about audits, because right now there's a good chance if you're not slashing your tax bill by 80%, that really it's that fear that's stopping you from moving forward instead of the actual tax code. So you've heard it, maybe you've said it, love to do that, love to save money, but won't that flag me for an audit? And often you might have heard that from your own accountant. Oh, you don't want to do anything. IRS is going to be all over this. And look, there are certain things the IRS really doesn't like. However, that doesn't mean there aren't good legal strategies that allow you to pay the least amount of money. And that fear has probably cost you tens or even hundreds of thousands of dollars. And it's not necessarily because the strategies themselves are risky, but because nobody ever explained the difference between what actually triggers an audit and what maybe your current tax team is just too nervous to sign off on. I've been doing this for over 30 years, and we filed thousands of returns using strategies that are completely legal, fully documented, and built directly into the tax code by Congress or the president. And in this video, I'm going to show you exactly what can trigger an audit, but more importantly, why just having an effective tax strategy to lower your tax bill doesn't have to be something you're afraid of, so you can proceed ahead without losing sleep at night. So stick with me for the next few minutes, because this could end up being the most expensive video that you never watch if you don't follow through with me to the end. So let's think about the tax code as it sits right now. Nobody knows the exact number of pages that the tax code is. The estimate is around 100 to 120. But an old mentor told me once, the tax code basically has about 50 pages of how the actual tax is calculated for individuals, maybe another 50 for businesses. And yet the rest of the code are strategies and exemptions, and I guess the best way to describe it would be one big series, thousands of pages long, of carrots and sticks that the government puts in place to direct behavior. The problem is most individuals have never really looked into the code, and often even your accountant hasn't really taken the time to dive in and see what's in there. So hopefully in this video I can dispel those myths. So let's start with a basic explanation of some examples of carrot and stick. Stick, great example. If you put money into a 401k, which is a government plan created by Section 401k of the tax code, or maybe you're in a hospital or something like that where you might have a 403b, your teachers have those, or a federal government with a 457. Those are just the codes outlining what happens. Put money in, it grows tax-free, you pay the tax, and the tax is calculated when you go to take it out at whatever the current rates are and your brackets are. Now the stick in there is if you go and pull that money early before you're 59 and a half, and there's certain exceptions around this, like 72T is an exemption if you retire early, allows you to take a set amount every year. But the penalty part comes in if you just take a distribution, you have to pay all the tax at your highest marginal rate for that year, plus an additional 10% of federal excess tax, really, it's penalty. And in states like California, it's additional 5%. So all the tax plus an additional 15% if you live in California. That's a stick, because the government is basically saying, look, we don't want you tapping into this money before you retire, because if you do and do it continually, you'll end up likely dependent on us. So that's an example of a stick. Carrot, you buy real estate, and if you rent that real estate out, a couple things happen here. Number one, you can often control the real estate with very little down, 10, 15, 20% depending. And now if it's a rental, you get a mortgage for the rest of that. If you do your job right and buy in a good area where these numbers work, and they don't in a lot of places these days, but they still do in parts of the country, you get enough rent to cover that mortgage, and you as the homeowner get to benefit from any appreciation and the ability to write off expenses. Depreciation, which is a paper loss based on the life of the property and the government acknowledging that structures don't last forever. They need to be improved, repaired over time. So the government gives you the ability to write off the expenses around the rental, property taxes, the mortgage interest, depreciation, which again is a paper loss, and any repairs and things like that. That's a carrot. So the government's encouraging that. Why? Because it provides housing. And lots of things in the code exist exactly like that. So in our process, where we work predominantly with W-2 wage earners that make over $300,000 a year, or business owners that are grossing at least $500,000 a year. And we are often able to come in and reduce their taxes by 50, 60, 70, 80%, and in some cases all the way down to zero, legally. Keyword legally. What do we do? How do we do it? Well, we spend a lot of time reviewing the tax code and looking for what behavior is the government trying to encourage. And how can we use that in a leveraged manner so we can put a dollar out and be able to write off $5, $7, $9, $11 legitimately within the code using things like energy credits. Even if you've heard that solar's gone away, you can't get a deduction anymore for buying an electric vehicle or putting solar on your house or a Tesla battery on your house. The government has moved the carrot, the incentivized behavior towards energy storage. So therefore, if you help participate that, we find those projects, and there's good ones and bad ones. Part of what we spend a lot of our time vetting is deciphering between those, but we found those will often give our clients $7 to $11 of deduction. And in many cases, the money out of pocket is very minimal, and you can, finance isn't really the word, but use credits to get that money back, or most of it, almost immediately. So that's an example. And if you think about the Trump agenda, and right now in 2026, when I'm recording this, they've made it very clear that they want America to have supply chain independence and food independence and energy independence and all these sorts of things. So by providing massive energy storage like a hospital would use, or a factory, or an urgent care, something like that, everybody wins in that deal. The user gets cheaper energy, often powered by solar, but remember, the government isn't necessarily giving the credit for the panels themselves as much as the storage these days. And I'm using that as an example because it's one of the few where you can actually, in deductions and credits, get back more than 100% of the project value. Built, again, right into the code to incentivize that behavior. So America wins because storage exists that helps free up other resources. The user benefits because their energy bill drops, and the individual that helps with these projects benefits because they're saving, for every dollar outlaid, they're getting back $2, $2.50, in some cases $3 fairly quickly. And that's unheard of in almost any return over any sort of length of time, even with Bitcoin when it was doing its best and things like that. So really understand that part of the reason potentially that your accountant or other advisors may have shot down some of these strategies is because there are some that are fabricated or made up or rely on complete suspension of common sense to make these projects work. Won't go into them, but you can look at the IRS's dirty dozen of sham business write-offs or techniques. But often there can be very legitimate ones that are very similar, but following the code very closely. So part of what we do in our work, myself and my team of accountants spend anywhere between 7 to 9 hours each every week researching these strategies to make sure they're ones that are firmly rooted in the IRS code. That's the baseline. That we have opinion letters substantiating those write-offs or those deductions or those credits that we're taking, that peers have reviewed them. We belong to several peer groups where we get together for the sole purpose of discussing these ideas and going over what can we do to save our clients more money. And every week we're looking at new strategies, vetting them for their integrity to the IRS code, but then also ranking and rating them just like you would rank movies or deliveries from Amazon or Prime or Netflix. And of course, we're only looking for 4.5 stars to 5 stars. It may be perfectly legal, but if it's a 3-star strategy, we're never going to use it or recommend it for a client. And again, these strategies exist in both high-income W-2 earners that can be applied to your situation, also business owners, and because I have a lot of firsthand experience in helping families qualify for grants and scholarships for college, although I don't really practice in that arena anymore, I more train others, many of them can help qualify for additional financial aid, legally, ethically, morally. So the process is intense because every time we bring on a new partner, we're looking very deeply into their background, again, the details of the strategy, and looking at the actual agreements to make sure they would withstand withstand any IRS scrutiny. So that's one reason when you're applying legitimate strategies inside those 100,000 pages, you don't necessarily have to worry about an audit, because even if you are audited, if it is a legitimate strategy, you don't have anything to worry about. In fact, for our clients, we actually pre-audit every file. What does that mean? It means as we're building the strategy out for the client, and it may involve 2 or 3 or 4 or 5 of these different techniques and legitimate strategies, we're also preparing all the documentation and all the paperwork so that if questioned, because that often can come a year or 2 or 3 later, then we've got all our documentation and ducks in order, so the audit should be fairly painless. And often these days, most audits are simply correspondence audits. Now let's talk about the actual number of audits being conducted right now. And I'm gonna have to read this just so I can remember some of it, but pulling this research together from several sources, including the IRS and other research sources, the IRS is currently auditing about 1 in every 200 returns filed each year for individuals. It's about 0.5%, or put another way, 5 in 1,000. So your odds are very good that this never even comes up. Now, that does change by income level, and they are auditing lower incomes more, and you might be shocked why. $50,000 of annual income each year is one of the targets for this administration in trying to root out fraud, because there are certain credits that you can take for having dependents where you pay nothing into the system but actually get thousands of dollars back. So obviously that's subject to abuse and fraud like anything else. So they're cracking down on that. But over the last couple of years, here's kind of the breakdown. If you have no income, it's about 3 returns out of 1,000. And sometimes it's a lifestyle audit where they're checking, how are you living the way you're living without any income? 25,000 to 50,000, 0.2%, 2 out of 1,000. If you go up to 50,000 to 500,000, the audit rate actually goes down. It's 1 return per 1,000 filed. Now, this is for individual taxpayers that don't have a business. We'll get to those numbers in a minute. After you go over $500,000 of annual income, then it goes up to 0.6%, 6 out of 1,000. At $1 million to $5 million, it's about 1.6%, so about 16 out of 1,000. Over 5 million, it's 31 returns out of 1,000. And then when you get over 10 million, then it's 11%. They really do $10 million or more of income is now you're at 110 out of 1,000, or about 1 out of 10. And they're trying to bump that up to 16.5%. So if you're making less than $500,000 and employing these strategies, or even less than $1 million, your odds of getting audited are less than 1 in 100. Now, when you have a business, that's a little different. Schedule C is the highest audited of the business returns that are audited. Sole proprietorship, where you're the business is you, the way most people get started. And that's between 1 and 2% depending on who you ask. So a little bit more. Partnerships and S corporations, it actually goes down to 0.2%, or 2 out of 1,000 returns. You do that math right? Yeah. That's right. C corporations, 0.4%, but those vary widely. So the bigger the corporation, over 250 million, it's almost a 10% audit rate. So the rates are very low and have remained such for many years. All the years I've been doing this, it's been pretty similar. And so don't let your fear of an audit stop you from doing something legal, encouraged by the code. It's why they put it in there, that can potentially save your family thousands, tens of thousands, or in some cases, we've saved our clients hundreds of thousands, and yes, even over $1 million a year in taxes. So if you're looking for someone to work with that you can trust, you're welcome to reach out. We'll be happy to explain to you where we can fit in, take a look at what you're doing, and see if we can help. So I'm Ron Carruthers with Carruthers Tax and Financial Solutions. Hope you guys really enjoyed this video. If so, please be sure to subscribe, like, feel free to share, and definitely don't be afraid of the IRS, especially what they put in there to encourage you to do things that benefit the economy.